Hi everyone, hope you're doing well out there. Happy New Year. First video of 2025. I'm going to start with a big one. We're going to talk about the 6 UK stocks I'm buying January 2025. So this is where I go through the stocks that I've been buying from the 1st of December to the 1st of January. And also I'll tell you about the stocks that I've sold as well, because I did sell one position out completely. I've done this video series for a long time. It keeps up the transparency so you guys can follow along what I'm buying, what I'm selling. Any stocks that I bought or sold will be on this video here today. So hope you enjoy the video, hit the like button, let's get started. Now just to let you know, the Patron, £5 a month, a link is in the description. If you join that, you get 2 exclusive videos a week and you get to know what I'm buying and selling in real time on there. It has been a very good year for the stock market channel, and also the Patron is going up level after level as well. In my opinion, it's the best UK investing stock market community out there in the whole of the UK right now. And as Patron keep reminding me, it's been 54 months since I last updated the price. So it's about time the prices are going up. Yes, next week the price is going to go up by 20% next week. So if you do want to get the cheaper rate, now is your time to lock in, as it's going to go up to reflect the amount of content that's on there now. 100 exclusive videos a year on there. And as well as that, the stocks that have been provided over there the last few years. Obviously, stock market beating returns. I can't justify keeping it only £5 a month now. It's got to go up a little bit. So lock in while you can. Obviously, you've probably seen from the last couple of years now, it's definitely worth the £5 a month, or the £5 a month you can get it for one more week, and it's going to go up. If you want to start investing, join Trading the link in the description, get a free share worth up to £100. That's personally the investing platform that I use. That's the platform I buy all these stocks on. Let's get started with number 1. Audiobooms. I have been buying Audioboom stock. I've been buying this stock real heavy in the last month. It's a new position and I've gone very heavy into it. I was seeing a lot of positives for this stock where I thought I'm going to have to capitalize on this. I was seeing insider buying, I was seeing profit upgrades, and the valuation looked cheap. This came from, once again, a member of the Patron on the Discord, Crystal Balls. He put this one forward to me. I had a look and I thought, you know what, this is a great pick. And that's what I love about that Discord community, is that it's like a scouting network. All the members are looking for great opportunities. And if it wasn't for the Discord, I probably wouldn't have seen this opportunity. Now, I have been buying this stock earlier on in December, so I am up over 30% on this position right now. I did make a video on YouTube about 2 weeks ago saying that this is my new UK growth stock. We don't have many growth stocks in the UK market, but this one is, and I am buying it. And if you bought from when I did that video as well, you're up a fair amount since I did that video. The stock has gone up nearly 23%. So yeah, if you're in the Patreon, you're up a lot more. If you watch that YouTube video, you're probably up a fair amount on this position as well. But I will continue to buy this stock on any kind of weakness. So Audioboom, what is it? It's a powering podcast for creators and brands. Audioboom is a leading global podcast publisher. We connect podcasts and advertisers with engaged and passionate audience. If we have a look here, you can see here, so Audioboom's in the middle. They link up the creators and their podcasts up to the audiences through Spotify, YouTube, Pandora and Apple Podcasts. They then link them up to the advertisers as well, so advertisers can advertise on the creators platform and then they get paid for it. Now, if you look at the historic performance of this company, it's been very good. The revenue growth has grown at 44% CAGR. They say that the industry is going to grow 22% until 2030, and they think they can get up to around about 260 million if they grow in line with the CAGR of the industry in 2030, which would be really nice. But if you actually look at Q3 revenue is actually outperforming what they've done previously, up 34% in Q3 alone. EBITDA moving up in the right direction, 3 million increase in adjusted EBITDA versus 2 million adjusted EBITDA loss in Q3 2023. And note this 1 million in advance creator payments. We'll talk about that one in a second. Now, the reason why this stock actually got so low to a cheap valuation, and if we just zoom out on the chart a little bit here, so you can see the stock really peaked in 2022 and then it fell off a cliff massively, and we have started to see the rebound in the stock price. Why did that happen? Well, it was a combination of factors really. So basically we had a slowdown in the downloads. So we had a big boom in the CV times and then everybody kind of went back to work. And then there was a change in the Apple iOS update, which basically stopped automatic downloads on your iPhone. That affected them. They also had the global ad market recession. So we had kind of like a nearly recession in 2022, 2023, and a lot of companies stopped their advertising. That's rebounded as well right now. And then we also had the advanced creator payments, which I just mentioned on the slide previously. So basically what happened in 2021, Audioboom made a bit of a mistake. They decided that, oh, this crazy performance we've had is going to last forever, ever. Everyone's going to stay at home, and we want the creators to stay with us. So what we're going to do with all the creators that come to us, we're going to try and attract them all, and we're going to make a contract that for the next kind of 3 years, whatever you get on your advertising revenue, it doesn't matter. We will pay you a minimum guaranteed fee that you'll get paid this amount. Now, as we saw, what happened is the advertising network absolutely dipped. Everyone went back to work and the podcast kind of flatlined for a little bit. And it was kind of a loss-making contract. So it really affected the profitability on Audioboom. In fact, if I just jump to the slide of the financials here, you'll be able to see that big dip that they had because of the go back to work in these contracts. Now, all these contracts have actually run out this year. So that's why we're seeing a big rebound now in the profitability, because all these contracts are coming towards an end as well. Now, also what's going on with the business is they have launched a new platform, which is called Showcase. So Showcase, as you can see here, made up around about 11% of the revenue in 2021. This was launched in 2020. Now, you can see here that Showcase actually makes up 31% of the revenue in 2024, and this is growing quite rapidly. This is the fastest growing part of the platform. I thought I had the numbers up for you guys, but I actually don't think I do. I'll have to double check that for you guys, but it's something like double-digit revenue growth at the high end as well. We're talking 70 to 80% growth. Now, this is growing rapidly, and this is growing faster than all these other platforms that they used to have, like Premium and Sonic. Now, this is growing massively, and the great thing about this is because the gross margins are 31%, this is higher than the previous two platforms they have. Showcase is able to connect advertisers to the podcasters quicker. It suits them better, so it can link up which advertisers better for which podcast a lot better. It can create adverts very quick for the provider, the podcast. It can make it in a few seconds. So because it's able to do all these things more efficiently, the impressions are going up, the advertisers seeing the results a lot better, the actual podcast are seeing the results better, and because it's a higher gross margin as well and growing rapidly, we've seen a major increase in the company. Now, what they've actually done is they came up with a trading update in the 15th of November saying guidance is ahead of what's expected. They did an update on the 11th of December saying we're actually going to have to hike up our guidance again, it's higher than what was expected, and they've got an update in January, and I actually think in January they're going to once again hike up the guidance once again. If we actually look at Stockopedia, which I've got a 30% off discount code in the description if you want to join, you can see here that the guidance at the moment is for a net profit of 2.3 million, an EPS of 14 pence, which puts it round towards a 36 times earnings. Now, Stockopedia at the moment have actually been slow to update these numbers because of the profit upgrades, and I think there's going to be a profit upgrade to come. I think we're actually going to be around about 18 pence of EPS. Now that actually puts it down towards probably something like a 22, 23 times earnings. I should have worked it out really quickly, but I'm doing quick maths on my head here. About 23 times earnings. Now, I think if this company is able to go to about 23 times earnings, and if you look at the growth that's expected for the next year, we've got this platform that's growing really well. I think we might even see some growth upgrades as well going on. We're probably going to see 10, 20% growth next year, 22 times earnings. The thing as well about next year is that we also had the first half of 2024 unprofitable. It's probably not going to be like that next year as well. So once again, you're going to see an even bigger upgrade for next year in 2025. So the 18 pence forecast that they have in 2025, when all these contracts are out, these guaranteed payments, I actually think that's going to be towards maybe a 23, 24 pence. Now, if you start running 23, 24 pence on this company with this growth, it's actually pretty impressive. And I really like the valuation here for the growth. And I think if anything as well, the Showtime platform is going to create very good revenue for them, great profitability for them. And I think if anyone's looking to buy out Audioboom, I think they're going to be looking at that Showcase platform going, you know what, let's go buy it out. So I really like Audioboom. Next one, a bit of another new UK stock into the portfolio, which is CVS Group. So this is a company that offers mostly veterinary services. It's been hammered. If we zoom out, you can see how much the stock has been hammered. So this is a pretty new position into the portfolio for me in the last month. If you look at Pets at Home, very similar, this stock has been hammered as well. So I've seen a lot of people hovering around the kind of vet space between Pets at Home and CVS Group. I personally went for CVS Group. Now the reason why CVS Group and Pets at Home are struggling is because there's currently a CMA investigation going on in the UK vet sector. So they're saying that there's too much monopoly, they're charging too many prices on the vet fees. Ultimately, what will the results be? I don't know. But I think it won't be too much of a slap in the face for a company like CVS Group. I think there might be some impact from it, but not as much as what's kind of being priced in. You know, we've had a 66% priced in dip on CVS Group. I mean, ultimately, how much can you go after a company and say, oh, you've got a monopoly or charging too much, when I think the company has like 6-7% profit margin or something around there? It's not like they're taking the mickey out of people, are they? So we'll see what comes out of it. I think maybe it's a bit too overblown. Now, I went for CVS Group over Pets at Home because Pets at Home, they're going to be massively impacted by the awful budget. The awful budget is going to lead a lot of people or companies that have to pay higher national insurance, and that's going to hurt a lot of bottom lines in businesses, and that's going to hurt probably Pets at Home more. They've got more staff, they've probably got lower paid workers because it has the retail segment where CVS is just pure pet play, and as well as that, Pets Home is probably going to have a lot more competition in the retail space because of their online presence. CVS Group is just mostly veterinary services, and a lot of the veterinary services that they offer going to be workers that are on higher amounts of money than the minimum wage and the national insurance. So what they're able to do is probably not soak up the cost pressures a lot more by unfortunately not offering the workers a lot more of the pay increases. That's probably how they're going to get around it. Looking at the company, they've got a 5-year plan. Revenue growth of 4 to 8%, margin expansion as well, hopefully, going forward. They're expanding into Australia. Now, the last expansion didn't go so well for them. However, let's hope this Australia expansion does go quite well for them. And if you look at the revenue growth, good track record of growing the revenue, good track record of growing profitability. As you see here, 86% of the revenue comes from the vet services. So yeah, mostly vet services, as you can see here, and that's growing at a pretty decent rate, as you can see here. Now, hopefully the EPS normalizes a bit. They had a drop in profitability last year from a few expenses, corporation tax, shutting a few businesses down. Bounce back next year, we're talking about potentially the net profit going up to around about 65 million, puts it around to a P ratio of 9, which I don't think is too bad considering what the historic P of this company has been, around about that kind of 16-17 times earnings. So yeah, I like CVS Group. If we can get it a bit cheaper, that'd be amazing, but I don't mind it at these sort of levels. Next one, JD Sports. What a year this has been. So look at that. 1st of January, no year to date available. So JD Sports actually had a pretty good year. It was rising up nicely as the year kind of went on, and then we kind of got the new government that came in, that spooked the UK economy, and the share price fell off massively. The thing is the fall off has been nearly 40% and put it towards nearly CV lows and Liz Truss lows, which is just way too low for, in my opinion. It shouldn't be this sort of level. Now, I'm sure most of you guys know JD Sports. They're pretty much everywhere in the UK high street, selling a lot of fashion brands, place to be, very popular. A lot of people like to go there. The JD UK brand is kind of maximised out. Where they're trying to get success from now is the expansion into the likes of the Europe and the US, which has done very well for them. One of the big concerns around JD Sports was always, oh, what happens if people pull away from them? There's no moat. You know, if Nike wants to pull the products away from them, they won't do very well. Well, we've seen in the last year, Nike tried to go direct to consumer and it didn't work for them. And basically they've had to go back to all their partners like JD Sports and go, we're really sorry. So if anything, it shows that JD actually has a pretty big of a moat, because people like Nike actually do need them. Otherwise their sales absolutely dipped and they cannot just go direct to consumer. Recent update was okay in my opinion. If we have a look at the revenue growth was delivering 5.4 organic sales, as we see here. They did talk about a bit of a slowdown in October because of the awful budget as well, but they did say that profitability is going to come a little bit at the lower end of the guidance. That was the reason why the market absolutely spooked and dropped massively, as we can see here. I think this is a bit overdone overall, to be fair. I think that, yeah, okay, there was a bit of, it was to the lower end of the profit guidance, but we're still talking about a company that, if I've got it somewhere around here, yeah, the company's currently 8 times forward earnings, which is just way too low. This company normally traded at like 20 times earnings previously, just way too low for a company like this. Way too much fear on saying that they're going to come at the lower end of the profit guidance, and also the fear around the UK economy, the national insurance that's coming in. I think you're just getting a quality UK company here for way too low. And you look at the past performance of the business, really good amounts. Actually, let's go further back so you can see how impressive it is a little bit more. Look at the revenue growth here in the expansion into the US and Europe. If we do look at the profit side of it, a really good ramp up of profitability kind of coming in here, as you see. Financial health wise, pretty decent balance sheet as well. There's a little bit of debt of an acquisition they made, but it's still pretty healthy when you look at it. They've got enough cash to pay that debt off. And I believe there's been a couple of insider buys going on as well. All kind of buying in the like £1 range, which is actually, the share price is actually lower than where they were buying. So you're even getting it cheaper than where the insiders bought. So yeah, you look at JD and 8 times forward earnings, and you look at someone like a Foot Locker, for example, which Foot Locker is like a 12 forward times earnings, and Foot Locker is on the floor. Revenue growth down massively, net income down massively. It's actually unprofitable at the moment. Yeah, it's horrible for them. And you look at Nike as well. Look how bad Nike numbers are at the moment, and yet JD is still putting in pretty decent levels of growth, really, considering. And at 9 times forward earnings, I like it very much at the moment. So yeah, I've been buying JD Sports. Next one, Hollywood Bowl. So I have just topped up the Hollywood Bowl position, not aggressively buying it, but every time the stock just kind of has a little bit of a dip, I do like to nibble on it. And as you can see here, it has been on a dip at the moment. 17 times PE at the moment, 4% dividend yield. If it has a special dividend, it is a little bit higher than that. Forward PE wise, it's around about 13 times forward earnings. There's a few one-time costs going on at the moment in Hollywood Bowl, so it's better to look at forward times earnings. I think 13 times forward earnings is too cheap for a company like this. I think it should probably be around about 18, 19 times forward earnings. I'm happy as well, just because I get a really nice dividend from it to hold the position and top up nicely. The latest earnings were pretty good. Revenue growth of 7%. EBITDA was up 5%, as you can see here. The big thing that's going to really help them drive up the growth in the next few years is their Canada expansion. So they're a UK bowling alley with amusements on the side and the bar area, which have all done very well for them. But they're kind of like getting to the point where they're a bit more maximising the UK market out. So what they did around about 2 years ago, is they decided, okay, let's look for another area to expand into, and the new area they've gone to is Canada. Canada is a area that is going to be a big growth driver for them. They've currently got 13 centres. There's room in the next few years to push this Canada expansion up to 20, 30, 40 centres. So there's clear growth drivers for the next kind of few years. And if they do what they've done historically, which they've got a very good management team, if they just nicely keep adding on to that revenue, keep adding on to that profitability. We talk about a company, the 2027 forecast here, 291 million of revenue and 43 million of profitability. If we have 43 million of profitability in the next kind of couple of years, yeah, I think the stock easily goes up 50 to 100%. I collect that nice dividend. Cracking balance sheet as well, so they have the option to keep just hiking up the dividend. No debt on there, as you see here. Pretty healthy cash balance, so hiking up the dividend, special dividends. And also what we've seen in the last couple of days is what you'd like to see when the share price is beaten up. Insiders come in and buy, and that's exactly what we've had. We've had the chairman of the board come in and bought some shares, and we had the CEO come in and buy some shares as well, and the chairman of the board then bought some more shares at £3, adding nearly 500k worth of buys from the chairman of the board, which is a pretty positive sign in my opinion. Next one, B&M. So we're on a theme of companies that are going to get hit by the national insurance impacts at the moment and the minimum wage from the awful budget and the government that's killing businesses at the moment. You see there's a theme that I'm trying to buy a few of these stocks up at the moment. And the next one's B&M. So once again, a stock that's been hurt on fears of the big increases of minimum wage and the awful increases of the NI at the moment. But I think it's probably pushed it to attractive value where maybe it's worth the risk. And the other thing with B&M as well is that if we are going to hit an economic slowdown, this is probably one of those businesses that I would expect people to still use because, hey, okay, we need to be a bit more careful on our spending. Let's go to more bargain retailers like B&M. So this would actually do, in my opinion, a lot better in an economic downturn, so I don't really worry about that too much. But you can see here, was around about £6 stock, fell off massively during the Liz Truss budget, went up a lot during 2023, and then it's really peaked around the kind of £6 range once again and fallen back down to the £3 range. 11 times earnings, which is historically a little bit cheap for this company. Normally this company trades at around about a 18, 19, 20 times earnings. So yeah, historically a lot cheaper. And if you look at a forward P, I believe it's like a 10 times forward earnings. Nice little 4% dividend yield. If they do special dividends, or we might see a share buyback from them, we'll see what happens. But if they do special dividends, that actually even puts the dividend yield up to like an 8-9%. So we'll see if that does happen this year. Obviously, most of you guys will know B&M. Once again, it is a bargain retailer in the UK, but very popular. People really do like B&M, and they are great stores. You know, people do love going to them. You know, it's one of those stores that I've never seen a retailer be able to have like a control on social media. Like, people on social media actually record and vlog going to B&M. I mean, it's crazy, isn't it? Like, you know, people actually film themselves going into B&M and showing people what they bought, because they do such great products, which is you know, such a surprising thing to say. But I guess people would say the same thing about us, is that people come and watch people talk about stocks on the internet. Why do people do that? But yeah, people find it interesting. You know, if you do have a look on YouTube, for example, you know, there's this couple here that have gone and talk about Christmas shopping at B&M with 23k views. If we go down here, another one, that's kind of like a living one. I kind of won't count that one. 10 things you should be buying at B&M. B&M shop with me, 35k views. Yes, crazy. You know, if you were to do the same thing about Tesco, there's nothing like that coming up at Tesco. The only thing coming up at Tesco is that a member of public saved security guard under attack. So it shows you the big difference. And yet Tesco is trading at 19 times earnings, a lower dividend yield as well. And when you look at the profit margins, I mean, B&M's a pretty high profit margin business, really. You know, you look at the profit margins for B&M, it's kind of like a 5-6% profit margin. Tesco's is like a company that is a 1% profit margin, or have they managed to get up to 2? Yeah, they've actually got up to 2% recently. So yeah, it shows you there's a big difference. And the big thing with B&M is they're currently at 764 stores. Their target is to get to 1,200 stores. One of the big things they're going to do is grow their France business. So they've actually expanded from just B&M in the UK into B&M into France, which has been doing very well for them, and that's where a lot of the store openings could potentially happen. And if they double the stores, lazy math tells you that they can double the revenue, double the profitability. The stock should do pretty well from here. It's already, in my opinion, a pretty cheap valuation. You know, 11 times earnings. I would argue the case that it probably should be at least 15 times earnings, and then you double the revenue and profit over the next kind of 5 years, and yeah, it would look very attractive at these sort of levels, in my opinion. And even with the tough time that we're going through, I think they could do okay. Going on to the next one, and the last stock that I'm buying, which is Money Group. So I've kind of got a little bit more nervous. I'm not going to lie, I got a little bit more nervous over Money Group in the last month, and that's because of some of the developments that are going on in the UK. However, I think it's probably still going to do quite well because it's so low in valuation right now. Just, I'm a little bit worried because some of the catalysts I thought were going to come in 2025 are probably not going to come in 2025 now. It might be 2026, so it could be kind of a dead kind of little period for Money Group, but I think the valuation is still pretty attractive. So same again, this stock is one that's been hurt massively. Really peaked in 2019, has fallen down about 46% since that time frame. 13 times earnings. Once again, this stock used to trade a lot higher. It used to be a company that traded at a 18, 19 times earnings, 6% dividend yield. So even if this stock doesn't do anything at the end of the day, you're still going to collect a nice dividend from it. Now, I thought what would happen is the interest rates would come down. That would speed up their comparison site. So Money Group, I'm sure most of you are aware, is a comparison business for Money Supermarket. And what was going to happen is I thought the economy would do a little bit better going forward with like the interest rates coming down, inflation's being beaten, interest rates will come down, and people would become, you know, buying houses more. People would be using the comparison site for, you know, the home insurance, using it for mortgage deals, looking at loans for buying cars potentially because the interest rates are lower. The economy would be in a lot better place, and people would be going for those bigger products because they're cheaper on the interest rates. However, interest rates at the moment don't look like they're coming down anytime soon. Basically, inflation has gone up because of the current UK government, because of the big pay increases that they've been doing, are going to continue doing. Also, the NI situation, businesses are going to have to put prices up to cover the NI cost. So inflation is going to go sky high in the next kind of couple of months, and that means interest rates won't come down. So that part of the business that I I thought would do very well in 2025 isn't probably going to happen now. The other issue that you have as well is that the energy price situation. So one of the big things that they used to have is the energy price comparison site. Looking at it, once again, we're going to see the prices go up. We're going to see it go up today. And then what we thought was going to happen is in spring, we're going to see energy prices drop again. And once again, they're going to go up. So it looks like potentially we're going to see no energy kind of price comparison come back in 2025, which, yeah, once again, thought we're going to come back about a year and a half ago and just doesn't seem to be coming back. But when you do look at the numbers, revenue-wise, we are going to still see maybe a little bit of a tick up from the other products that they do have. The insurance part of the business, the travel part of the business is still doing very well. Net profit should hopefully still start going up in the right direction, and I still think the valuation isn't too bad at the moment considering how beaten down it is, and the company still makes up major amounts of profitability, really good amounts of profit. Financial health wise as well, they have a pretty decent balance sheet, as you can see here, what you probably expect from a company like this. And the ownership wise, insiders have been buying, so it does give you a little bit of confidence, especially like the CEO, for example. He did buy on the 15th of November. Granted, it was a bit of a smaller buy. So I'm not really getting the catalyst of what I thought would happen for 2025, which has maybe going forward, I might slow down my buys on this one. But at the end of the day, it's probably that lower valuation right now, and you're also going to get a nice dividend that I can be a bit patient on this one, and then hopefully in 2026 we start seeing some of these catalysts come back, and the stock does really kick on. So it might be a little bit slower burning than what I originally thought, but I can stick around with that dividend anyway. And that's all the stocks that I have been buying. On to the one stock I sold, which I did make a video on, which is Watches of Switzerland Group. So I did sell my whole position in Watches of Switzerland Group. I sold it for something like a 60% return. Once again, what a fantastic year it's been for me in the last year in the stock market, and it only continued when we sold our Watches of Switzerland Group position out in December for a really good amount of profitability. I have done a full video on it, so if you want a little bit more detail, because I already realized like we're pushing towards 25 minutes, half an hour already on this video, so I don't want to keep you too long. But if you want more details on why I sold, I kind of did a 15-minute video here talking about it in full with more details. Mainly the reason why is that I just thought the stock had gone up, it priced in a lot of positivity, and I don't know if that's going to translate to the financials just yet, and that made me a little bit nervous about where the valuations, the risk to reward, and I kind of took my profit off the table, which it was very good. And the turnaround play has been successful. When I made the video around about 8 months ago saying I'm buying this new turnaround stock, Watches Switzerland Group, and obviously from there the stock has gone on to rally, which has been great. I remember when I made this video here, there was a lot of people saying, oh, it's a horrible stock, you won't make money on it, you can't predict turnarounds, and well, hey, there we go, we just locked in another major profit. And that wraps off the video for this one of the stocks I'm buying January 2025. Hope you enjoyed it. Best of luck for the next year. Hopefully it'll be as profitable year for you as last year. And thanks for watching, and I'll see you in a bit.